In this topic, we will build on our understanding of the FAIS Act and examine where it fits within South Africa's commercial legal framework. We have already established that the FAIS Act is one of South Africa's commercial laws and forms part of the consumer protection framework regulating the marketing of financial products. Before contextualizing the FAIS Act, we will first examine what is meant by a financial product. A financial product is a promise made by a product supplier to perform financially in the future. This performance is aimed at either protecting a client against financial risk or assisting the client to grow or preserve wealth. Consumers of financial products, especially in South Africa, are at a high risk of exploitation because of several factors. First, financial products are now for later transactions. The client performs immediately by paying, while the product supplier only performs at a future date. This places the client in a vulnerable position, as they must rely on a promise of future performance. Second, consumers do not make financial product decisions frequently. As a result, they often lack the experience and information needed to make fully informed choices. Third, South Africa's historical context has contributed to this vulnerability. During apartheid, a large portion of the population was excluded from access to financial products, leaving many consumers with limited exposure and financial literacy. For these reasons, it is essential in South Africa to have a robust regulatory framework to protect consumers of financial products. Financial products are broadly divided into the following categories: risk products, investment products, bundled products. Risk products are designed to protect clients against specific financial risks. Short-term insurance policies, which provide cover for risks such as vehicle damage, property loss, or cell phone damage. Long-term insurance policies, which provide cover for life events such as death, disability, or retirement. Health service benefits, which are provided by medical schemes to cover healthcare-related expenses. Risk products provide protection when a specified insured event occurs. Policyholders receive benefits, but generally do not have ownership or governance rights in the product supplier, except in the case of medical schemes. Investment products are designed to assist clients to accumulate, preserve, or grow wealth over time. Pension fund benefits. Group retirement products typically established by employers for employees. Friendly society benefits. Member-based savings or risk arrangements. Institutional issued investments. Investment issued by banking or insurance institutions, such as bank deposits and retirement annuities. Securities and instruments. Marketable investment instruments such as shares, bonds, and derivatives. Marketable investments can be sold to another party, while non-marketable investments, such as bank deposits, require engagement with the issuer to access funds. Bundled insurance products combine risk and investment elements into a single product. These products include a risk component, which provides insurance cover, a savings or investment component, which accumulates value over time. Endowment policies are a common example of bundled insurance products and are issued by long-term insurance companies in South Africa. The financial product market involves two key relationships: the relationship between the product supplier and the client, the relationship between the financial services provider and the client. Product suppliers are responsible for honoring claims and benefits in the future. FSPs are responsible for providing accurate and appropriate information to clients at the point of sale. Because financial products cover a wide range of offerings, they are divided into specific sectors to make regulation more effective. These sectors include short-term insurance, long-term insurance, pension fund memberships, bank deposits, friendly society benefits, medical scheme options, and collective investment schemes. Product suppliers are classified into sector categories based on the type of product they issue. Although all product suppliers operate within South Africa's general commercial law framework, each sector is governed by its own legal framework. These sectoral laws regulate the licensing or registration of product suppliers and govern the relationship between the product supplier and the client. The table on this slide sets out the product sector, the category of product supplier, and the applicable sectoral law. For example, short-term insurance products are issued by short-term insurance companies and regulated by the Short-Term Insurance Act, while bank deposits are issued by banks and regulated by the Banks Act. It is important to note that sectoral laws are prudential in nature. Their primary focus is to ensure that product suppliers remain financially sound and able to meet their future obligations to clients. The FAIS Act supplements common law by regulating financial services providers and their relationship with clients. As a result, the marketing of all financial products is regulated under the FAIS Act. The FAIS Act requires a business to obtain authorization from the Financial Sector Conduct Authority before rendering any financial services. The Act allows for differentiation by creating categories of authorization for FSPs and representatives. This ensures that the fit and proper requirements imposed are appropriate to the specific activities performed and the financial products involved. The FAIS Act also establishes fit and proper requirements and conduct standards to ensure that financial services are rendered competently, clients receive correct and appropriate information, and advice is suitable to the client's needs. Here are some common abbreviations used in the regulatory examinations. FAIS stands for Financial Advisory and Intermediary Services Act, FAIS for Financial Intelligence Center Act, FSP for Financial Services Provider, and FSCA for Financial Sector Conduct Authority. KI is Key Individual, and CO is Compliance Officer. To summarize, a financial product is a promise by a product supplier to perform financially in the future. These products are either risk products, investment products, or a combination of both in the form of bundled products. Every financial product has two sides, the issuing side and the marketing side. The issuing side is performed by the product supplier, while the marketing or servicing side is performed by an FSP. In law, businesses are defined by the role they perform in a specific activity, not by their name or overall operations. This means that when we make compliance decisions, we assess each activity separately, allocate the correct legal role, and then apply the appropriate regulatory framework. There are also two key legal relationships in the financial product market. Product suppliers are responsible for honoring benefits and claims in the future. Financial services providers are responsible for providing correct, appropriate, and suitable information to clients at the point of sale. Product suppliers are regulated under sectoral laws, which are prudential in nature and focus on ensuring that suppliers remain financially sound and able to meet future obligations. The marketing of all financial products is regulated under the FAIS Act. FAIS supplements common law by regulating FSPs and their relationship with clients. It requires authorization from the FSCA and imposes fit and proper and conducts standards to protect consumers. Together, sectoral laws and the FAIS Act form a comprehensive regulatory framework that protects consumers throughout the life cycle of a financial product.